So good morning to you all and welcome to our investor meeting, a virtual investor meeting broadcast to you live from our headquarters here in Iceland. Today we have CEO Árni Oddur Þórðarson and CFO Linda Jónsdóttir who will go over the second quarter results and some business highlights. And then we will dive into the Q&A session and I will hand over to the moderator. So over to you.
Yeah, thank you, Tina. Welcome. We can say surely that the second quarter was an eventful quarter for Marel. 60% of our people at the peak working from home, mirroring maybe our end consumers that are sheltering at home, dining at home instead of dining out. We put safety first in all our actions, precautious measures, high delivery performance, good project execution, good mix, although lower volume affecting the gross profit. Gross profit down 2.5% between years, but 2% down OPEX. Cash flow extraordinarily good, leverage 0.6% between years. So all in all, very good results. Year to date, we are on pair in order intake, record order intake in the first quarter. And then we see slightly down order intake in second quarter, mainly in meat when poultry and fish are keeping the momentum there. We can say most likely that poultry is the least affected industry in now. It is convenient, affordable, easy to cook at home. Surprisingly to see as well the momentum in fish, and not surprised at all to see order intake down in second quarter in meat. We have said it very clearly that when the turbulence go, and it's the least automated industry, as you can see by the news flow, people need to stop by, rethink the whole value chain, go for safety, social distance in the factories as well, more automation, more SKUs. All in all, as well, EBIT margin is 15% in second quarter, but maybe more realistic to see it close to 12% year to date. We don't know the full effect of the COVID fully going forward. There are still news flows that are negative coming out, especially in the Americas markets. It's more realistic to see third quarter somewhere between first and second quarter results in operation performance, although I have to highlight how pleased I am with Team Marel, dedication, passion, and underpin that our delivery performance is better than we have seen historically in Marel, because we have been working on all axes. There are few very good decisions that we have taken that are keeping us running, keeping the value chain running, keeping our partnership with our customers. It's unthinkable without the globalization and our local reach how we would have delivered right quality on right time in installation. We have 700 people in North America, 700 people in Latin America. We are still building up in Asia with 400 people out there, 200 in the commercial side, 200 in the back end in manufacturing. Remote connections, virtual trade show, replacing the conventional travel, leading to a very low OPEX in the quarter. Some of it will be structural. We see now how we can work differently, but strategic streamlining is as well encountering into this. 8 million annualized savings in strategic streamlining that we have achieved, kicking in second quarter, and we will continue. We have opportunities to synergize the back end in Europe while we are ramping up our front end. To sum it up, before we go into more financial details with Linda, our CFO, then poultry is returning in this quarter what we are used to see. 20% EBIT we are seeing here in poultry. We said very clearly in recent quarters that the low EBIT in fourth quarter and first quarter were mainly volume driven in poultry due to low order intake in the middle of the trade constraints and geopolitical tension in last year. We said as well very clearly that standard equipment, high gross margin, gross profit items started to kick in beginning of December, January, February, and has continued the momentum. Those sales are kicking in as revenues and leading to better mix in second quarter. As well, there is a high momentum in our aftercare business when we ramped up the inventories, and we have been delivering to keep the value chain running very well. In meat, as you remember, we are used to in the past to deliver 10 to 12% EBIT. Our targeted was 15% plus. Unfortunately, due to mix, we went down to 8% EBIT in fourth quarter last year. Then we went 4% down in first quarter due to pandemic effect. And now we are back at the fourth quarter level, 8-9% EBIT. To improve again and go back to the 12% EBIT and then gradually up, we need to change the mix. We are working very hard in ramping up the front end, structuring ourselves a little bit different, and standardization, modularization. The pipeline is building up again in our sweet spots in the pork processing and in the standard equipment. In fish, 10% EBIT, it's a bit higher than we have seen in the past. We are not yet out of the woods with 10 to 12% EBIT going forward, although I have to say that project execution, big projects that are based on standard building blocks are excellent in fish. And then we have tailwind compared to recent quarters in the currency. We have big part of the operation here in Iceland, although we are more or less naturally hedged on our consolidated level. So over to you, Linda.
Thank you, Árni. Good morning, everyone. Thanks for calling in. I'm going to take you through the highlights of Q2 2020. If we start with the order intake at the level of 280 million, impacted by the pandemics, 10% lower than the same period last year and also lower than last quarter, which was a record quarter. But important to highlight, if we look at the first half of 2020 compared to the first half of 2019, we are at the same level in order intake. So what we have managed to do is to retain a healthy order book throughout this period, which is very strong. Looking at the revenues at the level of 306 million, also going down from last year by around 6%, but higher than last quarter. We have managed to maintain our manufacturing sites open during the pandemics and running at good levels, improved levels from last quarter, but still not at like targeted utilization levels. Looking at the aftermarket, now at a level of 38% of revenues, where we do see impact on the service part because we are having logistical challenges for our field service engineers to get to the customer sites, but at the same time spare parts are at a good level. Gross profit 37%, improving from last quarter because of good project execution and good product mix, and still lower than last year. EBIT 14.7%, where we do see streamlining efforts kicking in. We also see impact on travel and exhibitions related to the pandemics. What we also see in the quarter is a very strong cash flow, 63 million operational cash flow and 48 million free cash flow, with a leverage of 0.6 times net debt EBITDA, which underpins our financial strength to take on further growth. Not less important, but like what we also saw during this period is great efforts and commitment from our people, like a lot of unity across the organization, people really working hard to address all the issues coming up day by day in periods like this. And I do really feel that we did unlock some value during this period in terms of ways of working. And I think we can take a step back and be very proud of how people at Marel reacted to the challenges at hand. So if I go a bit better into the numbers, good quality of earnings. I mean, this is also very important in a period like this, that you have the diversified revenue streams coming from the industry mix, the geographical mix, and the business mix. Looking at the industry mix, like it's similar to last year, with poultry delivering 53% of the revenues, meat 32%, and fish 13%. Looking at the revenues by geography, the biggest difference there is in Americas, we have now 33% of the revenues compared to 39% last year. We though did see some large orders coming in the beginning of 2020 that will positively impact the revenues in that region. Revenues by business mix, we now are delivering 38% of aftermarket revenues compared to 35% last year. And what we also do see that, like, even though we have logistical challenges on the service side, the aftermarket in total is growing by around 6.6% if I compare the first half of 2020 compared to the first half of 2019. Only looking at the quarter, the growth in aftermarket is around 3.5%. Resilient revenue generation. I mean, looking at the order intake and the revenues in the quarter, orders received 280 million, so roughly 10% lower than last year. Revenues 306 million, roughly 6.5% lower than last year, but higher than last quarter. As I stated in the beginning, manufacturing sites are open. We are delivering with good utilization levels, even though our target is higher. And we are delivering 38% from aftermarket in this period where spare parts have been very strong. Operational performance, what we do see is an improvement between quarters, comparing it to Q1. We do see some good project execution in the quarter. We also see a positive impact from product mix. Streamlining efforts are having impact on the results, as well as overall lower OPEX related to cost effects from the pandemics. Looking at the cost items individually, S&M at the level of 10.7%. There we do continue investing in the front line, as is our plan. But at the same time, we see lower cost because of lower travel across and lower cost related to exhibitions. In G&A, we have some one-off effect in the quarter, but at the same time, we see lower travel, so G&A at the level of 6.1%, R&D at the level of 5.8%. So we continue investing in R&D and the future as before. Combined OPEX levels are substantially lower than last quarter, and they are lower than they will be, like looking a bit ahead, because there is part of the cost that will come back after we see changes in pandemics effect going away. So like we should see some pickup on the cost side because of increased travel and increased exhibitions. At the same time, we are very focused internally on grabbing also the opportunities that we see coming now from changed ways of working. Utilizing the technology like less travel, doing more online, doing virtual exhibitions. So there's a lot to learn from the pandemics, and that's a part that we want to grab. I mean, I think this also relates very well with our sustainability efforts, and it's something we, as an organization, really need to focus on how we deal the best with. So OPEX low will increase, but still opportunities to grab from this period on the cost side. EBIT margin 14.7% in Q2. What we did also deliver was the streamlining efforts both in Q1 and Q2. In Q2, the effects are like on annualized savings around 2 million, with one-off cost not adjusted for of 1 million. If I look at the year-to-date numbers, the total saving is around 8 million, with one-off cost not adjusted for of 4 million. Order book at a healthy level. We started the year at a level of 414 million euros. We ended Q1 at a level of 465, and now we are down to a level of 439 because of order intake being lower than revenues in the quarter, but still growing from the beginning of the year. As we've stated before, our order book is combined of orders that are financially secured with down payments and/or a letter of credit, and the vast majority of the order book are greenfield projects, while spare parts and standard equipment run much faster through. Earnings per share. Our targets to deliver earnings per share to grow faster than revenues remains. We are delivering very solid cash flow in the quarter and this year, where we are investing part of it in the future, in innovation, infrastructure, and global reach. At the same time, we are very focused on disciplined capital allocation. We are paying dividend this year of around 44 million. At the same time, we are buying back shares for around 56 million. So approximately 100 million have been returned to shareholders this year. Looking at closer at the income statement, revenues of 306 million in the quarter, 6% down from last year. Gross profit at a level of 37%, lower than last year, but improving now from the start of the year. OPEX lower, delivering 45 million in EBIT compared to 49.6 last year. Results from operations, 42 million. We see net finance costs going up, also impacted by FX movements, and then income tax lower, 6.5 million compared to 10, delivering net results around 30 million in the quarter compared to 34 last year. Our midterm targets remain unchanged. As stated, like SG&A cost is in the quarter around 16.8%, while our long-term or midterm target is 18%. So is lower than our midterm target. And like our thinking there is, as I stated, like we will continue investing in the front line, we will continue investing in good cost for the future, but we will critically view all opportunities that we see on the cost side, also revealed by the pandemics and changed ways of working. Gross profit, midterm target, 40%, SG&A 18%, R&D 6%. And we also outline here on the slide the impact on EBIT from those midterm targets. Balance sheet, not a lot to highlight here. What we do see is a positive impact on working capital, even though we are building up inventories because we are very focused on our lead times, delivering at the right time to our customers. We have been building up critical parts, also related to spare parts. So we see build up on the inventory side, but we also see improvement on trade receivables in the quarter, so working capital impact is positive. We also see like quite some movement on the cash and cash equivalent. We used part of the strong cash flow and our cash position to repay into our revolver that we drew on in Q1. Balance sheet on the liability side, few things to highlight. I mean, leverage is at a very low level, 0.6 times net debt EBITDA. Compared to our target of 2 to 3 times net debt EBITDA, so that underpins our financial strength. In Q2, we also repaid the revolver, as I stated, 500 million of the 600 we draw in Q1, which was a precautionary measure at the time. Our liquidity, secured liquidity is around 720 million at quarter end, and we have committed funding in place until 2025. Strong cash flow generation. Cash flow in the quarter very strong, 63 million operational cash flow. We did pay taxes of around 7 million. We did invest both in tangible and intangible assets. Free cash flow of 48 million. Paid interest 2.8 million, and we invested in associates, and that's 1.7. That's our investment in Proximity. We purchased treasury shares, net impact on the cash flow 38 million, paid dividend 38 million. So we saw an increase in net debt of 37 million. So very strong cash flow and a large part returned to shareholders through share buyback and dividends. Key performance metrics, this is what we are constantly focusing on. Earnings per share, growing that faster than revenues. We are focused there on constantly improving our margin profile, being disciplined in our capital allocation. Free cash flow, very strong. We have a very good and solid cash flow model in Marel, and that is also enabling us to really invest in the future. Net debt EBITDA at a level of 0.6, which underpins our financial strengths. So this was the summary of Q2, and I give the word back to Árni.
Thank you, Linda. And it's amazing to see this quarter. And if you look at our aftercare business, that we are growing between years, although our service people were nearly unable to travel in April, May. It was good to see the manpower business at historical rate in utilization in June, though. And we can even do better. We have been investing very well in the systems and the setup and localizing the service. So going forward, our targeted utilization rate is better. And there we can see gross profit improvements going forward. But well done, team. In many cases, we needed to visit the customers more region by region. We were connected remotely, helped them, and the spare part business is thriving. We have the inventories ready. However, even though we are connected remotely with our customers, it is China for China. China is geographically equally spread as Europe. However, then we have a backup support from the Netherlands, Denmark, Iceland, or US in those installation or services. So it's an amazing quarter. On a personal note, it is a little bit strange to see that I'm used to travel around 60 hours per month, and that is one working week. So it's not traveling this quarter. Not having a to-do list in work, not having a to-do list to your family, and you have a little bit time for yourself as well. So this is maybe this is rebalancing everybody. And if we look now at what is happening in the global markets, and we look at the market and what are consumers doing. In recent 40-50 years, we have been gradually increasing consumption from away from home or home delivery. It's a little bit blended. Step by step, less cooking at home, less time spent on cooking. In 4 to 6 months' time, the whole picture is revised. Dining at home, preparing at home, going to 67-70% level. We saw downward slope in restaurants, quick service restaurants, and etc. Rebounding a bit, the winners are clearly home delivery of pizzas now that are up between years and etc. We should go, though, under the hood of those lines and recap what was happening. And this is a US picture. We are seeing online sales skyrocketing in India and so on. But this is US, where we have a lot of data. In April, when the pandemic was on a peak level and starting, then people went for bulky purchasing in supermarket once a week, frozen products, and etc. Now we are shifting. In some cases, due to lack of availability, people are experiencing more, going to other new stores 4 or 5 times a week, testing more locals, and then online is as well skyrocketing, where the brand loyalty is higher. So, but underneath, 4 or 5 times a week, it's more fresh products, it's more ready-to-cook products, and etc. Why am I saying this? Our processors, with partnership from us, need to be agile, need to have different market know-how, and even switch between SKUs, consumer products, within a day. It's undoable without seamless flow and interconnected solutions. So it's amazing to see such, and of course we will balance out somewhere in between, but who knows how long it is. But the story of those pictures is you cannot be dependent on one channel. You have to have the agility, automation, social distance in the factory, and distribution and marketing know-how to deal with different channels. We step in because it's a consumer demand, it's push. If we look now over to China, for instance, there is natural consolidation in the swine market or the pork market. That is the prerequisite for automation in the factory level. And then consumers are demanding, instead of wet market, for instance, there, supermarkets or online stores. We have the flexibility, we have the traceability, less water, less energy, more sustainable solutions. You know what we do here in poultry, meat, and fish, but what differentiates Marel is controlling all the processing steps and having a seamless flow. I said in the beginning, it's unthinkable how we would done this without building up systematically in recent 30 years and stepping on the pedal in recent 2 years in our local presence. Regional setup as well. We are organizing ourselves now in 6 regions that are in 3 reporting sets for the outside world, and we are as well getting some synergies in the back end by the twin regions. It is very important that we are there. Fly in, fly out is yesterday. You need to use it sparingly. Of course, sometimes we need to use economic scale and the best know-how, but we can do it smarter than we have done in the past. We need to breathe in and out with our customers out in the regions, the tasting of the menus, the differences in the menus, and etc. And we need to know exactly what are the customer needs at each location. Of course, we seek economic scale in the back end in manufacturing. We have the manufacturing hubs in every continent here, China, East Europe, and Brazil. Or Central Europe, and same applies to the warehouse build-up that we are now investing systematically in. People have been talking about, is sustainability a focus point in this turbulence? I personally believe it's more important than ever. We can reduce the waste, we can increase the yield, and we can reduce use of water energies as well. The prerequisite to think like this is to have diversity inclusion in your workforce. We lead by example, board of directors, executive team, and step by step. Gender diversity at the executive team level, it means a lot. We have different opinions. Geographical spread as well. We are 4 or 5 nations in the executive team. Same applies to the board of directors and the executive team. We have origin or domicile in China, US, Iceland, Denmark, Sweden, Netherlands, UK. So it matters a lot. We have had mandatory, if we go for the sustainability, that all our innovation projects go through screening and scoring in sustainability. You know how to run corporate, it takes time. Today the score is 87%. I'll let you to read the rest of this, and let's move to Q&A, the exciting part. But we are committed to the sustainable goal of the UN, and we are as well taking a precise step in science-based targets. And it is important, and we need to change the way of working. So we take it very seriously, and I can just say, to wrap it up, sustainability is our business here.
Thank you, Arnljótur. And then I would like to hand over to the audio moderator.
Thank you. If you have a question for the speakers, please press 01 on your telephone keypad. Please limit yourselves to one question and only one follow-up question per person. We have a question from the line of Akash Gupta from JP Morgan. Please go ahead.
Yeah, hi, good morning, Arne. Good morning, Linda. My first question is a situation on COVID-19 and how do you see demand from there? So, like, for example, if you look at slaughterhouses on both sides of Atlantic being shut down due to COVID-19 outbreak on the floor, given you supply mostly high-end and automated solution which requires much lower workforce, I assume. So I wanted to understand if facilities where you have supplied equipment did better job in virus breakout or there was no real difference, and whether that could drive incremental demand to increase automation when the things stabilize.
Yeah, thanks, Akash. The question is about the agility and the reverse, the shutdown of factories. I think this is a waking bell for many in the industry, but if we look though on, in general, poultry and fish have been investing, and I'm talking about on average, investing more in automation and agility than the meat sector. Our customers that have the market channel know-how and processing know-how and have been investing in smart flow are thriving or navigating better in this situation. There are as well meat customers that have been on the top and investing there, but more conventional business, and we see now we need more automation, we need more social distance in the factories, and etc. So it is unprecedented times that we are dealing with. However, like I showed you here in beginning, in the second half when I came in, that 3 months ago, and things happen very fast, people were shopping bulky items frozen. Going and invest to deal with that environment long term, because investment take 18 months for some of our customers and our innovation 6 years, would not have been wise. You have to stop by and see where the market is heading. So naturally, order intake down in meat in second quarter, but the pipeline is building up, and we will see changes in this. So gut feel as well that Marel customers, as we started in secondary processing and we are having the full line with overarching software, are navigating a bit better than the average Joe out there.
Thank you. And my follow-up question is on competitive environment in general. So just wondering if you saw any irrational behavior by some of your smaller peers which might be struggling during the crisis, and whether any of those are discounting prices to get cash through down payments.
Yeah, we are not seeing our competitors discounting and etc. We have seen it in the meat industry in recent 3 years, behavior like that. But and maybe releasing a little bit the prepayment terms. However, we should remind ourselves, we have been here long term, and I remember clearly 2009 when the financial were not as strong in Marel. We recently had taken on acquisition. We were listed in Iceland, not in Europe. And then many of our customers asked us, instead of prepayment, for bank guarantee. We request always prepayment, letter of credit, and that's our order book. I would think twice to prepay high sums into unlisted companies that have not transparency in the accounts or are over-leveraged. So it's not affecting our business to sum it up in second quarter, and I think it's important that we are seeing the order pipeline building up again on a decent price level.
Thank you.
And the next question comes from the line of Andre Mulder from Kepler Cheuvreux. Please go ahead.
Yeah, good morning. The first question would be, you've moved up your stock levels to shorten lead times. Have we already reached a sort of a maximum here, or do you intend to increase that further? And second question would be on the working capital client behavior. Do you see any changes there?
On the stock level piece, there we will continue to focus on following the trends in the market, and we will continue our focus on delivering in time to our customers. So it depends a bit on how the developments will be. I think one of our strong positions is that we can invest and build up inventories if needed, and we will do that if needed. At the same time, we are delivering on time at the moment. We are not seeing real hiccups, so I would say we are in a pretty good place there. On the working capital, what we do see is that in some cases we see some delay in securing the letter of credit. So in some cases, we already have the down payment, we don't have the letter of credit, so therefore we do not account for the order in the order book. But I would not say that this is of big magnitude. And on the trade receivables, we have been collecting well, so I would say we feel we are in a good position.
And maybe to add a bit to it, structurally in working capital inventories, we are standardizing, modularizing, and utilizing, cross-utilizing poultry, meat, and fish. So structurally we can lower that working capital, but on the other hand, maybe we went over the board in our fastest moving parts. So we can shorten the lead times in the standard equipment, and in turbulence time like this, the agility delivery times matter a lot. So we were under our targets in standard equipment sales last year, and now we are maybe building up for good a little bit more inventories in our blockbusters like Sensor Access that are making sure that we have a bone-free portions or contamination-free portions, and etc. etc. So it's a balancing. Our fastest moving part, maybe we build up more inventory, but structurally we are getting better and better.
Thank you.
And the next question comes from the line of Klas Bergelind from Citi. Please go ahead.
Yes. Hi, Arne and Linda. I was very late on the call, so maybe you have touched on this, but the first one is on orders in poultry. Did I hear you correctly that they are stable? But was that also on the larger side or only on the standard equipment? And could you also comment on what you saw in poultry in the US through the quarter? I will start there.
Yeah, so I said more or less stable in poultry and fish, and surprisingly keeping up the momentum. And you see as well that our aftercare business is increasing between years. That is amazing. It is maybe slightly down in poultry. However, they are down in meat in the quarter. And like Linda said, there are prepayments, not with letter of credit, that show that our cash flow is unusually strong compared to the order intake. So the downfall in orders between years is meat and poultry and fish keeping the momentum, and we are keeping the momentum as well in the high gross margin short cycles.
And also in the US there on the order?
US is, of course, year to date on a pretty high level, but there are January, February extraordinarily strong, and as expected, April, May very low. I usually don't go under the hood month by month, but it's difficult to talk about quarter by quarter because December, January, February underlying very good, although we book orders in March, but it happened then, and then June promising, and so far in July as well promising. So it is month by month atmosphere is, the mood is positive, negative, questionable, and etc.
Yeah, no, exactly, because
today the US is fine, even though the revenues are low, but that is because US was low last year, and of course the expectation is now that the total volume of chicken out of the factories in US will go down between years. So all in all, but we have seen Bell & Evans coming in, we have seen Costco coming in, and when people see those reference plants, they see a lot how they can change their business in line with the European standards.
Yeah, so you wouldn't say that US is a question mark into the second half. You feel quite good about the US poultry side as well.
Yeah. So in this situation, we are having promising pipeline in US, but whether that will crystallize in fourth quarter or first quarter, we don't know. But there is a need to modernize the plants in US and get more agility in the back end, especially in the secondary process.
Yeah, very good. My final one is on service growth. What was the mix between man hours and spare parts? Spare parts much stronger, of course, but if you could give us the exact number on how it grew between the two, I grew and fell. And how quickly do you think the man hours can come back? I mean, obviously it depends on the openings, but what pace did you see the man hours in June and beginning of July?
Yep.
So, I mean, if we look at aftermarket total, that's growing like, if you compare the first half of 2020 to 2019, by around 6.5%. Comparing quarter on quarter, like quarter Q2 2020 compared to Q2 2019, the growth is more limited, around 3.5%, where we do see service going down and spare parts are driving the growth. We don't detail out exactly the growth percentages, but like comparing this year to last year, we see double-digit growth in spares, while we see our single-digit now if we compare Q2 20 to Q2 2019.
And we have given historically 25% man-hour service and 75% spares, and April, May, very low in man-hour service, but the surprise is the utilization level in June. How positive it was.
Thank you.
And we have one more follow-up question from the line of Akash Gupta from JP Morgan. Please go ahead.
Yes, hi, thank you for the follow-up. And that is on M&A topic. So just wanted to check if M&A is a lower priority now given the pandemic and the streamline of operations. And I'm wondering if we should expect any details for remaining part of the year, or is it more of a topic for next year?
Yeah, we have a clear organic and external targeted growth. We are reconfirming our growth targets, 12% annual growth from 2017 to 2026, when we are now at 6-7% level. So if nothing is new under the sun, the consolidation wave is, the second wave is starting in our industry. What is different by Marel and many other good peers is that we have the digitalization and we have the global reach. Like I said, it's unthinkable how we could have delivered according to our promises around the globe without the local presence and the global reach. In our industry, there are many, many great family-run companies that are making outstanding standard equipment that fit very well in our seamless flows. So we are ready, organization-wise ready, management-wise ready, and you see our financial ready We are dancing a bit more than in the past. Returning the cash into the banks is no sign that we, regardless of where we are heading. We draw that line before the helicopter money came from the central banks of the world, and we draw as well to show that it's fully committed from the banks. It remained committed with a short notice. So let's continue to show discipline in capital allocation, and we will continue to show that, but we can become stronger with some partners out there, and I think many of them share it with us.
Thank you, Arne.
As there are no further questions, I'll hand it back to the speakers.
Okay, so many interesting topics raised in the questions today. That concludes today's meeting. I would like to thank you all for your time, your attention, and your continued support for Marel. Thank you and goodbye.